Kevin Warsh just ran his first Federal Reserve meeting. The Fed didn't move rates a single basis point, and somehow Bitcoin got cut, gold got cut, and the Dow gave up 500 points in an afternoon after touching a fresh record that very same morning. Nothing changed on paper, and everything changed underneath the surface. If that sounds like a contradiction, stay with me, because by the end of this video, you're going to understand exactly why a man who said almost nothing just rewired how the most powerful financial institution on Earth talks to the entire planet, why he quietly built himself an escape hatch in his very first week on the job, and why all of that is connected to a much bigger story. One that I think ends with an enormous wave of capital flooding into the one asset that nobody, not even the Federal Reserve, can print more of. Before we get into it, if this is your first time here, this is the Wealth Continuum, and what we do on this channel is take the headline everyone else is reacting to and show you the mechanism underneath it, the part that actually moves your portfolio 6 months from now instead of 6 minutes from now. So if that's useful to you, get subscribed, because what I'm about to walk you through is going to matter a lot more in the back half of this year than it does today. So let's start with what actually happened in that room on June 17th, because the headline writers got this almost completely backwards. The Fed held the federal funds rate at 3.5 to 3.75%, fourth hold in a row. Everybody knew that was coming. CME's FedWatch tool had a hold priced in at something like 97% before Warsh even walked up to the podium. If a rate hold was the whole story, markets would have shrugged and gone back to whatever they were doing 5 minutes earlier. They didn't shrug. They sold, hard and fast and across every asset class at once. And the reason they sold has almost nothing to do with the rate itself and everything to do with what Warsh did to the machinery sitting around the rate. First thing, the statement got short, brutally short. We're talking about a document that's run north of 300 words in recent meetings, getting chopped down to something like 130. That's not an accident, and it's not a style choice he stumbled into. Warsh has spent years publicly criticizing the way the Fed communicates, arguing that long, hedge-every-sentence statements actually create more confusion than clarity, because traders and algorithmic systems start parsing every single adjective like it's scripture handed down from a mountain. So he cut it, ruthlessly, down to something closer to a press release than a policy document. Second thing, and this is the one that actually moved markets, he killed forward guidance, gone. Not softened, not reworded, not buried in a footnote. Eliminated. For the better part of 2 decades, the Fed's playbook has been to tell you roughly where rates are headed over the next several meetings, so that the bond desks, the algorithmic trading systems, basically every serious player on the planet could front-run the decision before it even happened. That's exactly why rate decisions used to feel like non-events most of the time. The market already knew what was coming weeks, sometimes months in advance. Warsh just took that map off the table entirely. In his own words, forward guidance isn't well suited for where the economy currently sits. And as a general proposition, he doesn't believe it's a business the Fed should even be in. Now stop and ask yourself a question here, because it matters for everything that follows. What happens to a market that has spent 15 years pricing risk off a predictable roadmap the second that roadmap gets pulled out from under it without warning? It tightens. Not because policy actually got tighter on paper, because certainty got thinner, and thin certainty makes every single desk on Wall Street demand a bigger risk premium to hold anything that isn't cash. That's the entire sell-off in one sentence. Stocks fell across the board. The Dow gave back roughly 500 points after touching a fresh all-time high earlier that same session. The S&P dropped well over 1%, and the Nasdaq fell even harder, dragging Microsoft, Meta, Alphabet, and Amazon down with it. Gold, which is supposed to be the safe asset when chaos shows up, still got knocked down more than 2%, erasing something on the order of $700 billion of value in a single afternoon. Silver fell even harder on a percentage basis. And Bitcoin, which had actually rallied above $66,000 just hours earlier on optimism around a preliminary peace agreement out of the Middle East, reversed the entire move and slid back toward the low 60s, eventually dipping under 63,000 the following day. Uncertainty doesn't pick a side when it shows up uninvited. It just makes everybody flinch at the exact same moment. And here's the part that should genuinely worry you if you're trading around these events instead of just holding through them. This isn't even a new pattern. Bitcoin has declined following 8 of the last 9 FOMC meetings, regardless of what the Fed actually decided to do with rates, averaging something like an 11% drawdown in the 48 hours that follow. Think about that for a second. The specific decision barely matters anymore. What matters is that leverage builds up in the days before every single meeting, liquidity thins out as everyone waits on the sidelines, and the moment the actual announcement lands, all of that leverage unwinds at once, regardless of the outcome. That's not a fundamental story about Bitcoin being weak. That's a structural story about positioning. And if you don't understand that distinction, You're going to keep getting shaken out of a position you actually believe in for reasons that have nothing to do with the long-term thesis. And then there's the third thing, the part almost nobody in the mainstream coverage is talking about, and it's the part I actually think is the single most important signal to come out of that entire meeting. Warsh didn't submit a dot. Quick refresher. If you're not deep into Fed mechanics, 4 times a year, every voting member of the FOMC anonymously plots where they personally think rates are headed over the next few years, and the Fed publishes the whole scattered cloud of dots together. It's supposed to give the public a window into the actual range of opinion sitting inside that building. This time, the new chair, the guy literally running the meeting, simply didn't participate in his own institution's signature forecasting tool on day 1. And the dots that did get submitted were a lot more hawkish than anyone expected. 9 of the 18 members are now projecting at least one more rate hike before the end of the year, with 6 of those 9 penciling in 2 hikes, and the median projection for core inflation jumped to 3.6%, up sharply from 2.7% back in March. The market had been pricing the next move as a possible cut. By the time Warsh left that podium, futures markets had pushed the odds of an October rate hike north of 50%. On top of all that, he announced not one task force, but 5 separate task forces to review how the Fed actually operates. Everything from how it communicates to how it manages the balance sheet to how it interacts with markets day to day. Why would you do that? You're the brand new chair. The president fought a brutal, historically divisive confirmation battle. The closest Senate vote for a Fed chair in modern history, by the way, 54 to 45, specifically to put you in that seat so you'd move fast and shake the place up. So why slow walk your own forecast and hand a meaningful chunk of your authority over to a handful of review committees in your very first week on the job? Here's my read on it, and you're welcome to disagree with me in the comments because I genuinely want to hear your take. A task force is not a tool for making decisions. It's a tool for delaying them while still managing to look decisive in the process. You get to say you're listening hard to the experts. You get to point at a process instead of a person when something controversial eventually comes out the other end. And most importantly, you buy yourself cover for later. Because the real test of a Fed chair was never going to be his first meeting. Nobody remembers a chair's debut press conference 5 years down the road. What people remember is what the chair did the moment something actually broke. Volcker is remembered for crushing inflation in the early 80s at the cost of a brutal recession. Bernanke is remembered for 2008 and the alphabet soup of emergency lending facilities that followed. Powell is going to be remembered for the pandemic response, not for any random Tuesday hold buried in his 8 years at the podium. The task forces aren't the policy. They're the staging ground quietly being built right now for whatever Warsh does, the day a real crisis lands on his desk. And I think a lot of you watching already feel somewhere in your gut roughly what that crisis is going to look like, even if you haven't put a clean label on it yet. It's not a housing bubble this time. It's not subprime mortgages getting bundled into mystery securities that nobody on the planet fully understood. This time, it's artificial intelligence. And I want to walk you through exactly how this thing is wired together, piece by piece. Because once you actually see the wiring, I think you'll understand why so many serious investors are quietly positioning for the unwind already. Here's the setup. A handful of companies driving close to a third of the entire S&P 500's market cap have built a financing structure that, frankly, looks an awful lot like the layered, circular deal-making that detonated in 2008, just dressed up in different, much shinier clothes. One chip maker, now sitting north of a $5 trillion valuation, is pouring close to $100 billion into a leading AI lab. That same lab is leaning heavily on a cloud computing partner for the actual compute power it needs to function. That cloud partner is issuing enormous piles of debt to build the data centers required to deliver that compute. And the original chip maker is guaranteeing it'll buy back whatever capacity nobody else ends up wanting, all the way out through 2032. Meanwhile, a legacy enterprise software company has reportedly signed something on the order of $300 billion in contracts with that same AI lab, and has taken on tens of billions of dollars in fresh debt just to make good on its end of that bargain. Credit default swaps tied to that company have already started flashing yellow in the market. Sit with that chain for a second. Does that sound like organic bottom-up demand to you? Or does that sound like a closed loop of companies financing each other's revenue round and round so the entire stack can keep pointing at the next quarter and claiming explosive growth? And it's not just a handful of anecdotes stitched together by skeptics anymore. The actual institutional data backs it up. Bank of America's own fund manager survey found that more than a third of the professional money managers they polled now consider AI hyperscaler spending the single most likely source of the next systemic credit event, and that share had literally doubled in the span of just 1 month. The Fed itself clearly isn't blind to this. Regulators reportedly went directly to the major banks this past spring and asked them to start disclosing exactly how much private credit exposure they're carrying that's tied to this entire build-out. S&P Global projects this specific category of debt could nearly quadruple between now and 2028. And maybe the single most uncomfortable data point in all of this, a growing share of these loans are structured so the borrower doesn't even pay interest in cash at all. They just borrow more money to cover the interest payment. Total debt keeps climbing. No actual cash ever changes hands. That is a very specific, very recognizable flavor of financial fragility, and it's one we have absolutely seen before. So here's the question I want you sitting with for the rest of this video, because it's the whole point of everything we just walked through. When this thing cracks, and I'm not framing this as an if, I'm framing it as a when, what does Kevin Warsh actually do? We already know the answer, historically, because it's the same answer almost every single time something deemed too big to fail starts to wobble underneath the weight of its own leverage. The Fed doesn't let it fail outright. It floods the system with liquidity, it backstops the institutions that have suddenly gone insolvent on paper, and it tells the public with a straight face that this was absolutely necessary to protect the broader economy from a far worse outcome. In 2008, that meant Freddie Mac, Fannie Mae, the major investment banks. This time, I think the institutions sitting in that exact same spot are the AI hyperscalers and the chip makers underneath them, companies that have become so deeply woven into the stock market, the labor market, and now increasingly the private credit market, that letting them fail outright would risk taking a meaningful chunk of the broader economy down with them. But here's the part that I think almost nobody in the mainstream financial press is willing to connect out loud, and it's the entire thesis of this video. The Fed can backstop a balance sheet. It cannot backstop a chip. You can print as many dollars as you want, and it will not make a GPU twice as fast. It will not make actual AI revenue magically catch up to AI infrastructure spending faster, and it absolutely will not change the schedule that semiconductors improve on, the one we've all been calling Moore's Law for half a century now. Money printing solves liquidity problems. It does not solve a fundamental mismatch between how much capacity got built on credit and how much real revenue actually shows up to pay for it. So when the bailout eventually comes, and I think it comes, the only real question is the timing, you're going to have a fresh flood of newly created liquidity hunting for somewhere to land at the exact same moment that smart money has just watched the entire AI trade prove, in real time, that it doesn't deserve another dollar of fresh capital at any price. So where does that flood of money actually go next? I think a meaningful chunk of it goes into the one major asset class on the planet that is mathematically, structurally incapable of being diluted by that kind of printing. 21 million coins. Full stop. No central bank gets to vote to mint a few million extra when things get uncomfortable. No task force, no matter how many of them Warsh creates, can quietly expand that supply schedule behind closed doors. It is the single hardest scarcity constraint anywhere in the entire global financial system, and honestly, it's not particularly close to a second place. And think about everything else competing for capital in this new world we're building. We are heading toward what's being sold to us as an age of effective abundance. Infinite labor through automation, infinite computational power, infinite drug discovery running through AI models. Eventually, maybe even something approaching infinite cheap energy if the optimists are right. In a world like that, ask yourself honestly, what's actually still scarce? What's the one thing left that nobody can just decide to manufacture more of overnight because demand spiked? That's not a rhetorical trick. That's genuinely the question every serious allocator is going to be asking themselves the moment this AI capital cycle turns. And look, we're already seeing the early footprints of that exact positioning, even before any AI credit event has formally detonated anywhere. While Bitcoin was getting knocked around hard on the FOMC headline itself, on-chain data showed long-term holders quietly absorbing somewhere around 125,000 Bitcoin throughout the month of June alone, one of the largest single-month accumulation events of this entire market cycle. That is not retail panic buying a dip on some trading app between meetings. That's patient, large-scale, sophisticated capital, treating a sharp drawdown as an entry point rather than an exit sign, which tends to be exactly what happens at major inflection points if you go back and study the prior cycles closely. Strategy: the largest single corporate holder of Bitcoin on the planet, sitting on something north of 840,000 coins at last count, has continued adding to that position even through a stretch where its common stock and its preferred shares have both come under genuine, well-documented pressure. Whatever you personally think about that specific corporate structure or how much leverage is baked into it, the underlying behavior, quietly accumulating scarcity while everyone else on financial television is distracted screaming about the headline of the week, is exactly the pattern that's repeated itself at basically every major inflection point in this asset's relatively short history. Now, I want to be straight with you here, because I'm not in the business of promising you certainty about exactly where price goes next week, or next month, or even next quarter. Nobody honest can do that with a straight face, and frankly, anyone on this platform who hands you a specific number on a specific date is selling you false confidence, not real analysis, and you should be deeply skeptical of channels that do that. What I can give you is the underlying mechanism, and the mechanism is this. Every single time the system gets genuinely stressed and the printer eventually comes back out, capital is forced to choose sooner or later between assets that can be diluted away and assets that simply cannot. Real estate, equities, even gold to a meaningful degree, all carry supply that can expand, get reinterpreted, or get printed against under enough sustained pressure. Bitcoin's supply schedule is the one true constant nobody in this entire equation gets to touch. Not the Fed, not Congress, not whoever sits in that chair after Warsh's term eventually ends. Let's actually play this forward for a minute, because I think it helps to see it laid out as a sequence instead of just a thesis floating in the abstract. Picture the first real crack. Maybe it's a mid-tier data center developer that can't roll over its debt. Maybe it's one of these circular financing arrangements finally getting marked to actual market reality instead of optimistic internal projections. Credit spreads on AI infrastructure debt blow out fast. Equity markets sell the obvious related names hard. Within days, maybe weeks, the conversation in Washington shifts from, is this systemic, to how do we contain this? Because by that point, it clearly already is systemic. The Fed, under Warsh, leans on exactly the playbook those 5 task forces have quietly been built to justify. Emergency lending facilities, balance sheet expansion dressed up in new language, liquidity backstops aimed at institutions the Fed insists, with a straight face, are simply illiquid, not insolvent. Sound familiar? It should. We've watched this exact movie before, just with a different cast and a different ticker on the marquee. So here's what I'd actually be watching closely over the next 2 quarters if I were sitting in your seat. Watch the credit spreads on the major AI infrastructure debt specifically. When those start widening in a sustained way, not just a one-day blip, that's your canary in the coal mine. Watch what Warsh's task forces actually end up recommending once they report back, because that's going to telegraph the entire playbook well before any crisis fully hits. And watch on-chain accumulation data closely, because historically, the people with the deepest pockets and the longest time horizons tend to start buying quietly, well before the headlines tell the rest of the public it's finally safe to. Here's a question I genuinely want you to sit with, and drop your honest answer in the comments below, because I read every single one of them. Does the AI trade crack before the Fed's next meeting in the fall? Or does Warsh manage to keep the music playing longer than basically anyone watching this video right now actually expects? Because the people who correctly called the last 2 major shifts in this market weren't the loudest voices yelling on financial television. They were the quiet ones paying attention to the plumbing instead of the headlines, watching credit spreads and on-chain flows while everyone else argued about a single press conference. None of this is financial advice, to be completely clear with you. It's a framework for understanding how the next 12 to 18 months might unfold, and what you do with that framework is entirely your own decision based on your own risk tolerance and your own situation. But if you want to keep tracking the story with me as it actually develops, the Fed's next moves under Warsh, how this AI credit story plays out in real time, and what it genuinely means for how you're positioned heading into year-end, that's the entire reason this channel exists in the first place. Hit subscribe on the Wealth Continuum, turn on notifications so you don't miss the exact moment this thing actually starts to crack, and I'll see you in the next one.